It's October 2025, and somewhere in a glass tower on Wall Street, credit traders are staring at their screens in disbelief. The cost to insure against Oracle Corporation defaulting on its debt just hit levels not seen since the dark days of 2008. The number that is making headlines? Over $900 billion in market value swings, debt explosions, and credit default swap spreads widening to crisis levels. But here's the thing, this isn't just about one company. This is about the largest technological build-out in human history, financed by record levels of debt, with warning signals flashing red across multiple fronts. And the market is starting to realize that the AI revolution might have a very expensive price tag. Welcome to the story of how the artificial intelligence boom became a potential financial time bomb, and why credit default swaps, those infamous instruments from the 2008 crisis, are back in the spotlight, warning us of dangers ahead. If you find this deep dive valuable, hit that like button and subscribe to stay updated on the most critical financial stories shaping our future. Right now, we may be watching the start of another cycle. But before we go any further, I'm not a financial advisor, this isn't financial advice, and I'm not connected to anyone mentioned here. I'm simply analyzing public information and drawing conclusions. What you choose to do with it is completely up to you. Let's get into it. Oracle's debt bomb. Let's start with Oracle, because this is where the cracks first became visible. Oracle Corporation, the legendary database software company, made a bold bet in 2025. The company decided to transform itself into what it calls the fourth hyperscaler, joining Amazon, Microsoft, and Google in the race to build massive AI data centers. But there was a problem. Oracle doesn't have the cash mountains that its competitors possess. So Oracle did what any ambitious company would do. It borrowed. A lot. In October 2025, Oracle announced plans to raise approximately $38 billion in new debt. When combined with previous borrowing, this pushed Oracle's total debt load past $100 billion. To put that in perspective, Oracle's debt-to-equity ratio skyrocketed to 520%, 5 times its equity value. Meanwhile, Amazon sits at around 50%, and Microsoft at just 30%. But here's where it gets interesting for market watchers. Credit default swaps on Oracle's debt started exploding. For those unfamiliar, credit default swaps, or CDS, are essentially insurance policies against a company defaulting on its debt. When the price of this insurance spikes, it means traders are getting nervous. Oracle's 5-year CDS spreads jumped to approximately 106 basis points by mid-November 2025, the highest level since October 2022. In dollar terms, protecting $10 million of Oracle debt now costs about $106,000 annually. That might not sound catastrophic, but it represented a doubling from earlier in the year, and the trajectory was deeply concerning. Goldman Sachs reported that trading volume in Oracle credit default swaps surged to roughly $8 billion over 9 weeks, ending in November, compared to just $350 million during the same period the previous year. That's a 23-fold increase in hedging activity. Wall Street started calling Oracle's CDS the most important chart in AI today. Why? Because Oracle had become the canary in the coal mine for the entire artificial intelligence infrastructure build-out. The AI debt explosion? Now, let's zoom out and look at the bigger picture, because Oracle is just the tip of the iceberg. The 5 major spenders on AI, Amazon, Alphabet, Microsoft, Meta, and Oracle, raised a combined record $108 billion in debt in 2025 alone. That's more than 3 times the average over the previous 9 years. Alphabet issued $25 billion in bonds. Meta followed with massive offerings of its own. Even before Oracle's bombshell announcement, bonds sold by just Alphabet, Meta, and Oracle had reached $180 billion, accounting for more than 1/4 of all new U.S. corporate debt supply in 2024. Morgan Stanley estimates that global big tech companies will spend approximately $3 trillion on AI infrastructure through 2028. Here's the kicker. Their own cash flows are expected to cover only about half of that. The rest? Debt. Lots and lots of debt. To understand the scale, consider this. In the first quarter of 2023 alone, the 5 largest tech companies spent approximately $320 billion on AI infrastructure, more than double the $151 billion invested in 2023. Projections suggest this could exceed $1 trillion by 2031. And this is where things get eerily familiar to anyone who remembers 2008. The 2008 parallels. Nobody wants to talk about remember credit default swaps from the financial crisis. They were the instruments that amplified the subprime mortgage meltdown, turning a housing crisis into a global financial catastrophe. Now they're back, and the parallels are unsettling. Deutsche Bank, one of the key players that profited from selling credit default swaps tied to subprime mortgages before the 2008 collapse, is now using similar structures to hedge AI infrastructure loans. They're employing something called synthetic risk transfer mechanisms, where the bank keeps loans on its balance sheet but sells off the credit risk to outside investors. Sound familiar? These structures strongly resemble the collateralized debt obligations and credit default swaps that amplified the 2008 crisis. They bundle and repackage loan exposures, separating and trading credit risk independently. Designed to distribute risk, such instruments can instead magnify it during downturns. But there's another troubling element that's emerged: circular funding. Consider the recent $100 billion deal between NVIDIA and OpenAI. NVIDIA pumps $100 billion into OpenAI to bankroll data centers. OpenAI then fills those facilities with NVIDIA's chips. NVIDIA is essentially subsidizing one of its biggest customers, which artificially inflates actual demand for AI. This circular funding dynamic extends throughout the ecosystem. Tech companies invest billions in AI startups, which then use those funds to purchase chips and cloud services from their investors. The same capital appears multiple times on different balance sheets, creating hidden fragility that misleads investors, creditors, and regulators. As Morgan Stanley's chief investment officer, Lisa Shalit, warned, we've seen an expansion of the ecosystem to include companies with weaker balance sheets like Oracle and CoreWeave. More debt, and we've also seen more interlocking and circular revenue relationships. That interconnectivity between the players brings systemic risk. The private credit powder keg. While public attention focused on Oracle and the tech giants, another crisis was quietly brewing in private credit markets. Private credit has exploded to $1.7 trillion in recent years, much of it lent to middle market borrowers with optimistic cash flow models. This market operates in the shadows. Loans that don't appear on standard balance sheets, structured through special purpose vehicles that make it difficult to track who ultimately holds the risk. And cracks are starting to show. BlackRock, the world's largest asset manager, faced a stunning revelation in November 2025. About a month prior, BlackRock had deemed private debt it extended to Renovo Home Partners worth 100 cents on the dollar. By mid-November, after Renovo filed for bankruptcy, BlackRock's new assessment was zero, a 100% loss. That same month, another BlackRock private credit portfolio performed so poorly that the money manager took the rare step of waiving management fees. The portfolio, funded through collateralized loan obligations, failed key performance tests, forcing automatic diversions of interest income away from riskier tranches. More than 1 in 10 private credit borrowers are now deferring cash interest payments, and at least 45 firms have been taken over by their lenders in 2025, the most in 6 years. The trailing 12-month default rate for private loans hit 1.3% by summer 2025, up from less than 0.5% 3 years earlier. BlackRock executives tried to downplay concerns, with Michael Patterson saying defaults are a healthy rebalancing after a decade of easy money. But the combination of rising defaults, opaque structures, and interconnected risks raised serious questions about systemic stability. The market's verdict. So what does all this mean for markets? The answer is complex and concerning. In February 2025, the S&P 500 experienced its worst day of the year, erasing approximately $900 billion in market value in a single session. NVIDIA alone saw its market cap swing by $900 billion in wild volatility, gaining $450 billion after strong earnings, only to give it all back when macro concerns resurfaced. Credit spreads, the premium investors' demand to hold corporate bonds over safe government debt, started widening across the board. Microsoft's 5-year credit default swap protection jumped from approximately $20,000 annually per $10 million of debt in mid-October to about $34,000 by late November. What makes this particularly notable? Microsoft holds a AAA credit rating, the highest possible. That means Microsoft's credit default swaps trade at levels more than 50% wider than a fellow AA-rated company, purely because of AI-related concerns. The pattern repeated across tech names. Meta, Amazon, and Alphabet all saw credit default swap costs creep higher, even though these companies have far stronger balance sheets than Oracle. Goldman Sachs paused a planned $1.3 billion mortgage bond sale for CyrusOne, a data center operator, after a major outage at CME Group reminded investors that data center customers can abandon providers after repeated breakdowns. The three bubbles converging economists and market analysts increasingly describe the current situation as a triple bubble, 3 interconnected financial bubbles that could amplify each other's collapse. Bubble 1, the AI infrastructure boom. An estimated 12,000 data centers power AI and the digital economy, with nearly half in the US. The European Union has announced plans to commit $20 billion to new AI gigafactories. Construction costs for AI data centers can reach $50 to $60 billion per gigawatt, 3 times that of traditional data centers, with more than half allocated to purchasing computing hardware like NVIDIA GPUs. Bubble 2, the debt explosion. Mark Zandi, chief economist at Moody's Analytics, notes that debt issuance by AI and technology companies in 2025 dwarfs that done around Y2K before the dot-com crash. The critical difference? Internet companies before the dot-com bust didn't have much debt. This time, the boom is debt-financed, making a potential crash far more dangerous to the broader financial system. Bubble 3, circular financing. The interconnected nature of AI financing creates systemic risk. When NVIDIA funds OpenAI, which buys NVIDIA chips, which inflates NVIDIA's revenue, which justifies more funding, the circular loop makes it difficult to distinguish genuine demand from artificial inflation. The warning signs multiply. By December 2025, warning signs were proliferating across multiple fronts. Barclays downgraded Oracle's debt rating to underweight, warning that Oracle could face a significant funding gap starting fiscal year 2027, beginning June 2026. The bank's analysis suggested Oracle might deplete its cash reserves by November 2026, just 11 months away as of this writing. Barclays noted that even if Oracle doesn't increase capital expenditure further, the company's cash could be exhausted within a year. With a debt-to-equity ratio of 500%, Oracle's credit rating could drop to BBB, nearing junk bond territory. Moody's downgraded the U.S. sovereign credit rating in 2025, citing deteriorating fiscal health. Meanwhile, U.S. credit default swaps hit their highest levels in 2 years, with one-year spreads rising from 16 basis points at the start of 2025 to 52 basis points by mid-year, a more than threefold increase. The cost of insuring exposure to U.S. government debt increased amid unresolved debt ceiling negotiations, though analysts emphasized this reflected political risk rather than insolvency concerns. Still, the rising costs signaled growing nervousness about U.S. fiscal policy. What could go wrong? Let's game out the scenarios that have analysts worried. Scenario 1. The monetization problem AI infrastructure requires enormous upfront investment, but monetization remains uncertain. If companies cannot generate sufficient returns from AI services to justify the infrastructure spending, debt service becomes problematic. This is especially concerning for Oracle, which has negative free cash flow and relies entirely on future AI contract revenues to service its debt. Scenario 2. The technology obsolescence. Risk computer hardware that comprises most AI data center costs may become obsolete faster than the debt can be paid off. George Calhoun, professor at Stevens Institute of Technology, warns the cycle of innovation in the chip industry is much faster than for wireless technology or fiber optics. There is a real risk that much of that hardware may become competitively disadvantaged by newer technologies in a much shorter time frame. Scenario 3, the overbuilding trap. With thousands of data centers under construction globally, overcapacity becomes a real risk. Ruth Yang, global head of private markets analytics at S&P Global Ratings, warns, "I think that there is a risk of overbuilding, and if the economy really is going to weaken, it's going to be a problem." Scenario 4, the credit contagion. If one major player stumbles, interconnected financing relationships could amplify the damage. As one analyst noted, if OpenAI fails, the snowball effect of that is going to be substantial. Oracle is particularly vulnerable given its dependence on AI business, while larger tech companies have more diversified revenue streams. Scenario 5, the liquidity crunch. Private credit markets could face a liquidity crisis if defaults continue rising. With opaque structures and illiquid positions, a rush for exits could trigger fire sales and mark-to-market losses across portfolios. Banks exposed through various hedging relationships could face their own pressures. The bull case, such as it is. To be fair, not everyone is panicking. There are arguments for why this might not end in disaster. Oracle structures its AI compute contracts as non-cancelable, non-modifiable, take-or-pay contracts, according to Bank of America analyst Brad Sills. This should ensure stable cash flows and cost visibility, if the contracts are as ironclad as claimed. BlackRock's Amanda Lynham argues that defaults in public credit markets peaked in November 2024 at 7.7% and are now declining. She sees dispersion but not widespread market disruption ahead. Tech fundamentals remain strong. NVIDIA reported robust third-quarter earnings with AI data center revenue up 66% year over year. The technology itself works and is transforming industries from healthcare to manufacturing. Unlike the dot-com bubble, today's tech giants generate massive cash flows and profits. Amazon, Microsoft, and Google aren't speculative startups. They're trillion-dollar juggernauts with proven business models. And perhaps most importantly, The Federal Reserve and global central banks are far more aware of systemic risks than they were in 2008. Regulatory frameworks have strengthened, stress testing has improved, and authorities are actively monitoring the situation. The question everyone's asking, so where does this leave us? The title of this video references the $900 billion swap that broke market confidence. But the reality is more nuanced. We're not dealing with a single event, but rather a complex web of interconnected risks that are causing market participants to lose confidence in the sustainability of AI-driven debt levels. Oracle's credit default swaps have become the most watched indicator in AI infrastructure. When they widen, it signals the market believes the AI build-out is outpacing monetization. When they tighten, it validates that the massive capital expenditures will pay off. The broader tech debt explosion, $108 billion in 2025 alone for the top 5 AI spenders, represents either the foundation of a revolutionary technology transformation or one of the largest misallocations of capital in history. Credit default swaps, those controversial instruments from 2008, have reemerged as both a hedge against AI infrastructure risk and a potential amplifier of systemic danger. The irony isn't lost on market veterans. Private credit, a $1.7 trillion shadow banking system, adds another layer of complexity and risk that regulators are only beginning to understand. And the circular financing arrangements create hidden fragility that could surprise markets when stress finally arrives. Here's what we know for certain. The market is nervous. Credit spreads are widening. Hedging activity has exploded. And the cost of insuring against corporate and sovereign defaults has risen to levels that demand attention. The next few quarters will be critical. Will Oracle successfully execute its AI strategy and prove the doubters wrong? Will tech giants generate enough AI revenue to justify their infrastructure spending? Will private credit defaults remain manageable or cascade into something more serious? The answers will determine whether we are witnessing the birth of a new technological age or the setup for a financial crisis that makes 2008 look quaint by comparison. One thing is certain. When credit default swaps are flashing warning signals this bright, ignoring them is rarely wise. Market confidence, once broken, is difficult to restore. And right now, that confidence is hanging by a thread. The $900 billion question isn't whether AI will transform our world. It almost certainly will. The question is whether we'll bankrupt ourselves building the infrastructure before the transformation arrives. Only time will tell. But the market, through the cold, hard logic of credit default swaps and widening spreads, is placing its bets. And right now, those bets are hedges against disappointment.